Would you like to have your home finance records reflect a balance sheet that shows an accurate net worth? Then you need to watch this video, Recording Unrecorded Assets and Liabilities. If you have any questions about this topic, you can leave them in the comments section below and I'll do my best to help you. And of course, if you feel the video helped you, I hope you will click like and don't forget to subscribe to get updates on new videos that come out all the time. We learned how to record assets and liabilities that were acquired after we started using QuickBooks for our home finance records. However, the question is, how do we record assets and liabilities that were acquired before we started using QuickBooks? Well, we can make an adjusting journal entry to add these things to our QuickBooks records. You only need to do this if you need a balance sheet that reflects your net worth and have that balance sheet be in your QuickBooks records. Most people leave the schedules of their assets for depreciation and their long-term liabilities with their accountant and only update those schedules once a year, and you could keep them separate from your QuickBooks Home Finance records. However, if you wish to have a balance sheet that's part of your QuickBooks records that shows this information, then you need to add any asset or liability that you failed to record at the moment you started using QuickBooks. In order to do this, you need to make an adjusting journal entry for each of the assets and each of the liabilities that you wish to add. If you add assets to your records, that means QuickBooks will reflect that you have more net worth. And we know that in order to increase an asset, you would make a debit, and therefore to increase your net worth, you would make a credit. For example, let's imagine in 2014, Joe purchased a car for $15,000. And that's what he paid for it in 2014. He would like to include that in the balance sheet that QuickBooks will show. So what will be the result if he adds that to the balance sheet? Well, the car as a fixed asset will show up for the first time as $15,000, and original net worth, which is now zero, will become $15,000. And its original net worth, because this was an asset that you had physically, that you owned before you started using QuickBooks. So this $15,000 is part of the original net worth. So let's take a look at how to record that journal entry. From the main menu, click Company, Make General Journal Entry. Now we know we started using QuickBooks in June of 2016. So you could really go to June 1 of 2016, the day you started using QuickBooks, and we know we have to add the car because the car is not in the chart of accounts. But you can add an account on the fly by clicking Add New, and this is a fixed asset, Continue, and very simple, Car, Save and Close. And we had a car that we paid $15,000 for, and it was part of our original net worth. So our original net worth, or the amount we indicate as our original net worth, will increase in our QuickBooks records because we're putting the car in our QuickBooks records. When we click Save and Close and Save Anyway, we click the trial balance and we can see we now have a new asset called car, and our original net worth showed up for the first time as $15,000. You can even click Reports, Company and Financial, Balance Sheet Standard, A for all, and now you see you have more of the asset car, which means your overall assets increased, and original net worth increased to $15,000. Now you may say, wait a minute, I'm worth more than that. I got a really good deal on that car. It was an antique worth $50,000. So what do you do in a case like that? Well, you're asking, why can't I show a balance sheet that reflects what the asset is really worth? Well, that's an age-old question. How do we record the value of our assets? Do we record it at historical cost, which means what we paid for it? Or do we record it at market value, which means what we can sell it for and what it's really worth? Well, let's look at the pros and cons. If we use historical cost, we can always prove that amount, and the amount will stay the same on your books as the asset sits there and is physically the same all the time. And it reflects the original amount that it affected your net worth when you originally purchased it. So we really need historical cost as a basis to value the asset. Now, if we used market value, what would be the problem? Well, first, we would need a certified appraiser to determine and declare the value of the asset, and that can be tricky. And that's because the asset value, or the value of any asset, changes all the time from day to day. So therefore, it would be impossible to adjust in our QuickBooks records on a daily basis or even a monthly basis the change of every value to every asset. So how do we deal with showing the people an accurate balance sheet if we paid a certain amount and we have to record that in our books, but the asset is really worth a different amount? The way to handle that is to simply put a footnote at the bottom of the balance sheet explaining what the real value is, or let's say the market value is, at the moment that you're displaying the balance sheet. And that's how we manage that when we report our financial information. So in this example, we will leave it as $15,000. Even though it's not worth $15,000 at the moment he includes the car in his QuickBooks records, it must be recorded as $15,000, and a footnote will go on the balance sheet. Now we will do the liability. Again, for a liability that you're adding after you started your QuickBooks records, you would still make an adjusting journal entry. The liability on your books and records will increase, but your net worth will decrease. Why is that? Why will your net worth decrease if you add a liability to your books and records? Well, if assets make your net worth go up when you add assets, and liabilities are the opposite of assets, then when liabilities go up, net worth goes down. It's that simple. For example, let's imagine Joe went on a 3-week vacation back in 2015 that he originally agreed to start paying for in June of 2016. And the amount of the debt is $2,500, and he never included that in his original QuickBooks records. He should have added this debt when he started the QuickBooks file, but we can add it now anyway. So now he must include it to have an honest balance sheet that will show his true financial position. So what will we do? Well, we know if liabilities are increasing and net worth is decreasing, that in order to increase a liability, we will make a credit because liabilities are normally on the credit side. And since net worth is normally on the credit side and we're decreasing net worth, we will make a debit. So just follow the steps. If you never learned debits and credits, just do it the way we show here. Credit the liability and debit the net worth. And the net worth that we debit will be the original net worth because this was a debt that was acquired before we started using QuickBooks. So this is how we do it. We make a journal entry, company make general journal entry, and again, this is the date that we started using QuickBooks, and you can use this as the date of the entry. Now, we have to add a new liability account, and if it's expected to be paid back in a year or so, you can put it as other current liability. If you expect to take longer than a year, generally speaking, the rule of thumb is 1 year. If you're going to pay it off in more than 1 year, you click long-term liability and continue, and we can call this vacation loan. And we click Save and Close. Now, we're going to credit for the amount that was borrowed and never paid back, and the debit lowers the original net worth because it was something that was not originally included that makes our net worth go down because we're recording more of a liability. We click Save and Close, Save Anyway, and now when we look at our trial balance, we now have this vacation loan for $2,500 and our original net worth decreased. We can even look at the balance sheet, reports, company and financial, balance sheet standard, A for all, and now you can see you have the credit cards that you originally had, and then you also have, for long-term liability, this vacation loan that gets added to your total liabilities, and your original net worth is now $12,500.